now that we're talking about the climate for the company, what should you be identifying within that climate? And the first thing is going to be, is the stock in an uptrend or is it in a downtrend? Now, just like I spoke about earlier, sometimes it makes a lot of sense to look and see, does the chart align with the earnings trends? So as we were talking about Lam Research earlier, I was showing you that the earnings are trending higher as the stock is overall trending higher. So as we stack the odds in our favor, it's important to have everything pointing in the right direction. The other thing that you need to focus on is the next earnings report, because depending on the expiration that you're looking at, if there is an earnings report in them, you better believe that there's going to be embedded premium in them. So let's go ahead and talk about earnings for a minute. Now, stocks can move wildly after a report, right? There's new information that hits the market. The stock could either gap up, it could gap down. You need to be aware that after earnings, a stock can move drastically. Now, the options market will have earnings events priced in. So you have to realize that if the earnings event is on March 1st and you are holding March 15th options, that earnings event is already priced in. So there's embedded volatility premium. So you have to be aware of this and always know when that earnings date is. So volatility premium can decline after the earnings event. So heading into the earnings event, volatility might be amped. After that event, after the news hits the market, that volatility premium can decline. So stocks can move dramatically pre and post an earnings event. So you just need to be aware of that. So as you assess the climate for the company and what you need to identify, looking at the overall trend of the market actually makes a lot of sense. So this is a one-year chart of the S&P 500. And so 2017, really nice, very good uptrend. There really wasn't a care in the world. And then all of a sudden, it looks like something happened and the market pulled back dramatically. So imagine if right around this area, you go and make a bullish options trade on a stock. What do you think is going to happen a couple weeks later when the stock pulls back 10%? Well, you're going to be hard-pressed to find an option that was bullish that's going to make money in that type of event. Now, if you happen to get lucky and you were betting that the stock would go down, a market falling 10% that fast oftentimes is going to affect almost every stock. So remember, understand the climate, where we are, what's happening in the past, and what's happening now. You need to consider that in your options trading. Not only do you want to look at the S&P 500, but you also want to look at the VIX. So the VIX is looking at the 30-day implied volatility of the S&P 500. So this is also known as the fear gauge. So as you can see here in 2017, there really wasn't much to worry about. So a reading that's low, that's almost in the single digits, basically said that there's not a lot of uncertainty here, so there isn't much to be worried about. But then you see something happened. And what happened, what the story is that a lot of people were making bearish bets on the VIX. So they were shorting this volatility, and then a trigger happened. Everybody was short. They were clamoring to get out. They had to cover by buying. And then you see this huge explosion where the VIX went roughly from 10 to 37.5. So imagine what that's like. In an event like this, if you're betting that stocks are going to go up and then the VIX shoots up like this, it's very hard to make money. However, if you were lucky enough to say that, hey, you know, we're sitting at these low volatility levels, maybe there could be a blow up that could happen, and you were lucky enough to put on a bearish bet, in this environment, you probably would have been able to make a lot of money. So as we talk about sentiment, there's other things to look at. And so my firm, Map Signals, what we're looking at is unusual institutional activity. And so here we have 0 to 100%, and then we have the Russell 2000 on this axis. So what we're seeing here is this black line is measuring unusual institutional activity. So as this black line is increasing, it is basically suggesting that institutions are buying a lot more in relation to selling. This blue line here is the Russell 2000. So that's another common stock index. It actually looks at small cap stocks. So what our research has found over the years is that when we get into this red area, or 80% and above, it tends to be a forward signal of an overbought market. And so what happened going into this volatility blow up that we just saw with the VIX is we had an overbought reading in our research that we went out to our clients and said, listen, institutional buying is so high, it's so dramatic that if you look back in history, when we get to those levels, we tend to see a large pullback in the market. And so just like clockwork, what happened? The market fell 10%. We got ahead of that. So people with that type of knowledge could have been out there and putting bearish bets on. Now, the point of this is you don't have to use my analysis, but you need to have a holistic approach when you're going to assess options trading. Take everything into account, find the indicators that you like that especially have a historical precedence, and then use that to your advantage.